And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. Now, with the elections over, the ETF world is buzzing about how the Trump presidency will impact the ETF business. How are hopes for tax cuts, fewer regulations, and more tariffs impacting what ETFs investors will be buying in 2025? Let's talk with Matt Bartolini. He's head of America's ETF research at State Street Global Advisors, and of course, owner of the Spider ETF business. Also joining us, John Dobby, founder and CEO of Astoria Portfolio Advisors, joining us here at the NYSE. Matt, I'll start with you. You are, I like to call you the master of ETF flows. Don't want to toot your horn too much, but you tell me you've seen some very big moves in the last few days. What specific industries are we seeing notable inflows?
I think first and foremost, the U.S. listed ETF industry took in $22 billion in the day after the election. That is a record amount for post-election flows, shattering the record from 2020, which was just around $5 billion. And on a month-to-date basis, ETFs are now at $60 billion of flows in just November alone, and are just under $900 billion for the year. Now, what we've seen investors buying in the last few days has been very U.S. equity focused, a lot into large caps. We have seen some flows into small caps, $5 billion on just the day after the election. But you also started to see some cyclical exposures too. You saw financials. Financials have $3 billion of inflows post-election. A lot of that's gone into regional banks and bank stocks that may be able to benefit under this new administration's policies around regulation, but also the potential for steeper yield curves.
John, I've talked to you, and you have sort of similar thoughts, but tell me, what are you seeing here? What are the biggest ETF beneficiaries of a red sweep?
Yeah, so I think going into elections, very few people anticipated the red sweep. Now that we have one, I think that's a catalyst for things beyond the S&P and like the NASDAQ QQQs to do better. So we're at Astoria Advisors, we're tilting away from market cap weight indices. We think equal weight, we think small caps, we think, cyclicals in general, industrials. If you think about the cocktail of lower taxes, lower interest rates, pro-growth policies, pro-domestic policies, that's a very different playbook the next 3-4 years compared to the last 4 years.
Yeah. I want to talk about whether we're actually going to get lower taxes and lower interest rates. That's not remains to be seen. We're acting like we are, though. But I want to hit on some of these trades because it's remarkable to see some of these inflows, how the market's reacted. Now, Matt, State Street, your firm, you guys manage the Spider Regional Bank ETF. The KRE is the symbol there. You had messaged me that last Wednesday, the KRE had inflows that were 36% of the fund's assets in a single day. And folks, if you don't know it, that's unheard of in a single day. That just doesn't happen. And I'm sure, Matt, it's a record. Telling what's moving all the bank stocks and ETFs.
Yeah, that flow was a record, significant interest into regional bank stocks and banks overall. And I think it just comes down to sort of three central things. The first is earnings. The fundamentals are heading into the election were strong. And also you have the Federal Reserve starting to lower interest rates, and that could be beneficial because you have supportive loan growth. So that's the first point is that the consumer remains resilient, earnings and fundamentals are resilient as well in the banking space. The other two is around the election and the outcome or potential outcomes for lesser regulation for the financial industry. And then again, this inflationary policies that are being put forth on the campaign trail that could lead to higher interest rates on the long end while the Federal Reserve is lowering interest rates on the short end because that inflation policies actually have a lag effect to it. So you have wider yield curves, and that could be positive for net interest margins. So bank stocks saw that sizable sentiment shift right there.
You agree with this, I gather. It is rather remarkable, though. A 10% move up in these bank ETFs almost in 5 or 6 days. We're talking about big companies here. This is not, tiny little businesses here, particularly regional banks.
Yeah, we like KBWB, the large cap money center bank. So that's like Morgan Stanley, Goldman Sachs, the big bellwethers. And that was up prior to the 10% outperformance the day after the election. That was up 40% in the last year. So I agree with a lot of what Matt said. The fundamentals were leaning well for financials prior to it. And now this is just a catalyst to catapult it even higher. Remember, the last 3-4 years, Bob, 10 years, all people want to own is mega cap tech and growth. And you're starting to see changes on the margin. And again, the red sweep, which no one really kind of had in their bingo card, is a catalyst for you to rotate.
Yeah. I want to move on and get a couple other sectors in here. Matt, you also mentioned to me big inflows into crypto ETFs. I know you guys, State Street runs the Galaxy Digital Asset ETF Deco. That just launched a little while ago, folks, in September. A collection of various businesses involved in crypto. But it seems to me like the big winner here is Kathy Wood and her ARK Invest ETF, ARKK, and maybe ARKB. These have been called Trump proxies. She owns Tesla in this, in ARKK. She owns Coinbase and Robinhood. Those are Bitcoin proxies. And the fund's now at a 2-year high. But she's also had massive outflows in the last 2 years. So yes, the prices are up recently, but outflows. And I guess the question is, the both of you, can Kathy get her and other people involved in speculative tech get their luster back with this?
Well, I think if you just take a big step back and look at the industry overall if you take a big step back and you look at the industry overall for digital assets, in the digital assets space, you have an administration that is going to be more crypto-friendly in terms of their regulation policies and potentially lesser hurdles for cryptocurrencies and other digital assets to start to receive broad-based financial institution support. So I think when we look at this idea of transformational technologies or more speculative technologies that are developing in a fast-paced changing environment, the ability to utilize actively managed strategies to decipher the winners and losers around either regulatory-inspired headwinds or just ongoing usage and adoption of digital assets, I think that could be beneficiary, and that's obviously why we have our Galaxy partnership, because you need to understand how the cryptocurrency market is progressing, particularly around new administration policies.
So that makes sense, though. I've had my issues with Bitcoin, whether it constitutes money or is a separate asset class, but blockchain technology seems to be quietly advancing. I know most of this centers around Bitcoin and get-rich-quick schemes, but blockchain is advancing as a concept, as an investable concept, not just as supporting a cryptocurrency, but to do real estate transactions, to settle contracts, to do DeFi, smart contracts, clearing even for stocks potentially. It's potentially very exciting technology.
Yeah, for sure. I'm with you. I think that active management is probably better in something like very specific, like crypto and digital assets. So, again, I think there's certain things you should be active, certain things should be passive. Large cap equities, probably go passive. But what Matt's doing with Galaxy, seems like it makes a lot of sense. I mean, yes, like Trump's cabinet will be pro crypto. I would just caution viewers that a lot of it's in the price. I mean, Bitcoin is up 80% year to date. A lot of it was front run on the ETF flows. Yes, they've garnered a lot of assets, but in this business, entry price is everything, and it's rallied quite a bit. So I would just be careful and tactical with your entry points if you choose to kind of go ahead and buy either Bitcoin asset or crypto equities.
I want to just chat briefly about the other side of this trade, and that's the risk side of this trade, Matt. So where do things like tariffs fit in? I mean, it seems like things like industrials and maybe consumer staples that have to deal with prices overseas could be hurt by tariffs, importing stuff. And yet I look at broad industrials last week flows. I look at transport ETFs, and you've got some of them. They all saw inflows here. Can you sort this sort of contradiction out for us, Matt? John, I'll get your thoughts too.
Yeah, I think on the tariff-related impact, still we don't know where the tariffs are going to be placed. Again, a lot of these are proposed policies, and there will be a lag effect associated with them. I think on balance, the losers of this idea of more onerous tariffs around the world are non-US equities, and we saw that take place quite significantly in terms of market returns, but also flows. Non-US equity exposures have had outflows ever since the election. I think internally in the US, I think all else equal, those policies are here to, say, protect US manufacturing, and that should impact the sort of reshoring trend that we have seen and bring more domestic lines of support and supply chains, which could be beneficial on balance to all of small caps. On a sectoral basis, transportation stocks that do have those US dominant supply chains, the more mid and small cap exposures in the transportation network, not these large conglomerate transportation firms, those mid and small ones might be able to benefit from that reshoring and more domestic spending and more domestic manufacturing. But it's still a little left to be desired in terms of how it impacts industrials writ large. I would say that the biggest loser, though, of these tariff potential policies would be just non-U.S. equities because there's a lot of history and precedent than the last go around.
Gee, we were just hoping that overseas might open up a little bit more, but you can't help but agree with them. So Mexico, there's what is it, EWW, the Mexico ETF, the Canada ETF, maybe the China ETFs. There are many of them out there. Those are obvious concerns that are out there, and yet, I don't know. They've been terrible performers this year. Any of the China ETFs have been terrible performers. Can we make any case for owning any outside? Basically, the world just flees to the United States for everything. Europe's underperformed again this year, even though it hasn't been terrible, but it's still underperforming. I'm trying to figure out, where does an international portfolio fit in the age of potential tariffs?
Yeah, it's been a long way, for U.S. equity markets. I mean, I sort of agree. I think that, the tail risk is that, obviously, Trump, a lot of these policies could be very inflationary. I think you have to pick and choose, and I kind of, I'll point to what Matt was saying. I think small cap industrials make more sense than more large cap industrials. Listen, it's been a tough way the last 5-10 years for non-U.S. equities, but you can't help to think that, pro-growth, pro-domestic policy, by a red sweep, would benefit more kind of small caps. I would just caution, bond investors too. The deficit's already pretty big. When Trump was in office in 2016, deficit as a percentage of GDP was 3%. Now our deficit as a percentage of GDP is more 6.3%. So ironically, a lot of what is being talked about what he wants to do will be inflationary in general. So I think you have to, be careful if you own bonds for sure. But we're overweight the U.S. I think that's the playbook, the right playbook, in the next few years until the midterms. Right, we have 2 years of kind of where he can control a lot of the narrative.
Right. Matt, what about, John was mentioning bonds. This seems very tricky right now. We saw inflows into the broad bond categories last week, like AGG, which is the broad one, broad ones, the Vanguard total bond. There were inflows there. Long-term Treasury ETFs, like the 20-plus ETF, saw inflows, but flattish on the shorter end of things. This is kind of tricky to figure out right now. What's the right way to look at this right now?
Yeah, I mean, this is a market where you have evolving monetary policy meeting with new fiscal policies from the administration that could prove to be quite inflationary and have an impact on interest rates. And that's why we still see interest rate volatility relatively elevated. I think in this type of marketplace, because you do have tight credit spreads too, where they're essentially 40% below long-term historical averages, this actually reinforces the case for active management within fixed income, to manage that rate volatility, but then also to use security selection to identify those credits that may have potential further upside from a credit spread valuation perspective. And I think on balance, though, what we've seen investors do in ETFs from a sector perspective has been piling into credit exposures because of the market environment that is still somewhat risk on and could be beneficial to those that are taking on risk in the form of credit, which is a sort of implied equity bias to it as well. But in the core, using active, I think, makes the most sense going forward to manage some of those risks.
You're an RIA. What the average person going through this, would you recommend they change their portfolio? I mean, an average person whose aggressive portfolio might have 70% stocks, 20% bonds, and 5 or 10% other kinds of investments like cash and gold. Would you make a sudden move out of bonds or into bonds or anything like that? It seems like the best advice is almost to do nothing right now if you're confident in your allocation right now. Isn't that the most important thing?
Yeah, sometimes the best thing is to do nothing. What I would say is that, my inbox has been flooded from RIAs, advisors, and retail investors, what they want to do. Our message has been consistent. Like, we went into this year very constructive. We said, look, the earnings recession we had last year is over. The earnings environment is improving. Matt talked about that a little bit. The Fed was going to cut, and then the average stocks valuation actually was not that expensive. So we've been trying to get advisors to kind of get out of bonds and money markets. There's still $6 trillion in money markets.
Yeah, they love those money market funds.
They love those money markets, but the S&P. What has the S&P done in the last 2 years? Right, it's up 60%. Now it's being driven by Mag 7, but there's so much emphasis on bonds and a lot of products being issued on bonds, but equities, we want advisors to own more equities, right? Maybe your 70-30 shouldn't be 70-30, maybe it should have been 80-20. And those are the conversations we're starting to have. So,
Yeah.
Be careful with bonds.
The other risk, we were talking about tariffs, but the other risk is valuations that are out there. I know you've spoken about this. President-elect Trump is going to inherit a stock market at the very top end of its valuation range. I mean, isn't it fair to say the easy money has been made in the S&P 500? I mean, how much? 50% in 18 months or 19 months? I don't know what else. I've been 34 years at CNBC. I've rarely ever seen anything like this. You know, you've been trying to get advisors to move ahead with this. You've called it a market clearing event, essentially. That's the problem I have at this point. How much more are you actually going to throw at this price into the market?
Yeah, for sure. And if you look at the earnings growth of the, let's say, the non-Mag 7 versus the Mag 7, you are starting to see incrementally, you know, the non-Mag 7 actually have higher earnings growth than the Mag 7. If you do any sort of quality filter on mid-cap, small-cap stocks, you know, you're looking at 13, 14 times earnings, S&P at 22 times. So, you know, that's kind of what we've been telling advisors too, is like you don't have to go internationally and own Chinese equities, European equities, which still have a lot of risks, whether it's the Ukraine war, you know, tariffs in China. You know, there are value stocks, value themes in the U.S. So I think, you know, my sort of prediction in 4 years after Trump's presidency is that we're going to look back and say, okay, you know what, small caps actually did outperform large cap stocks.
Matt, we've talked about the stuff that's seeing flows, banks, small caps, industrials, cyclicals, crypto, non-Mag 7. What about 2025? Any surprise 2025 trades that are going to be we're not talking about now?
Yeah, I mean, I just listening to this past conversation, you'd maybe say the outside chance that maybe non-U.S. equities are the sort of contrarian idea,
yeah.
And maybe folks want to pile into non-U.S. equities for valuation reasons. I just think that's also sort of hard-pressed to think that will come true, just given the growth advantage within the U.S. I do think that you will see more flows into non-tech. I think you will see a broadening of earnings. You've already started to see that. I think you'll see more small cap, mid cap, more cyclically oriented industries, financials, industrials, consumer discretionary. So nothing really, mostly a big surprise. I just think it won't be such a heliocentric market led by tech stocks. I think we will see broader depth in this sort of U.S. dominance. And, you know, again, that could be beneficial to the U.S. listed ETF industry, where we're starting to see more and more capital going in because mutual funds are in net outflows this year.
Yeah. That makes a lot of sense to me. I want to talk about that in the podcast that's coming up in just a moment. This has been a great discussion, folks. You see how fast things move in this business. Pay attention. When you see KRE, a big bank ETF, have 35% inflows of its total assets under management in one day, 35% of it in one day came in for that. That's how fast these things move right now, and you need to sort of have a plan to be on top of all of that. That does it for this week's ETF Edge, folks. My thanks to Matt and John. We've asked John to stick around and provide more perspectives on what ETFs he is advising clients to own for 2025. That is coming up in our ETF Edge podcast. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.